As the summer winds down, most Canadians might not be paying attention to the latest earnings reports from the country's major banks. However, these earnings should be on everyone's radar, given how closely tied they are to the financial well-being of millions. Whether you hold shares directly, through a pension plan, or via mutual funds and ETFs in your retirement accounts, the success of Canadian banks plays a significant role in your financial future. For decades, the Big Five banks, Royal Bank of Canada, that is RBC, Toronto Dominion Bank, that is TD, Bank of Nova Scotia, that is Scotiabank, Bank of Montreal, that is BMO, and Canadian Imperial Bank of Commerce, that is CIBC, have been pillars of stability. They operate in an oligopolistic environment, benefiting from government regulations that limit foreign competition, allowing them to deliver consistent returns. Traditionally, their earnings reports have been predictable, often meeting or slightly exceeding expectations, and accompanied by regular dividend increases. It's no surprise that these banks pay annual yields between 3.5% and 6.5%, without ever cutting dividends since the country's confederation. However, recent events are signaling potential trouble. The global financial community once lauded Canadian banks for their resilience during the 2008 financial crisis, but the current landscape, marked by rising global interest rates, is revealing some cracks. Benjamin Sinclair, an equity analyst at Odlum Brown, remains optimistic about the long-term prospects of these banks, but warns that they face significant challenges in the near future.
For instance, TD Bank recently posted its first quarterly loss in decades, driven by a massive provision of $2.6 billion related to fines from money laundering investigations in the US. BMO also missed its earnings targets, with shares dropping over 7% due to rising loan loss provisions. CIBC narrowly avoided a similar fate, posting a profit despite ongoing issues with its US commercial real estate portfolio. This decline in performance has not gone unnoticed by analysts, who are becoming increasingly cautious. The once dominant buy recommendations are now being replaced with hold, sell, and even short positions. For instance, only 6% of analysts currently rate Scotiabank as a buy, while a staggering 25% advise selling. Similar trends are visible for CIBC and TD Bank, where sell recommendations are gaining ground. Despite these challenges, some experts, like Paul Gardner of Avenue Investment Management, argue that the situation isn't entirely bleak. While Gardner acknowledges the declining return on equity and rising costs due to inflation, regulatory changes, and a flat yield curve, he remains confident in the bank's ability to maintain their dividend payouts. For now, he continues to hold RBC shares, which have shown a 22% return over the past 6 months. In summary, while the latest earnings reports may have brought some unwelcome news, the fundamentals of the Canadian banking sector remain strong. Investors should stay vigilant, however, as the headwinds facing these institutions could have broader implications for the Canadian economy and individual financial portfolios. The dividends are safe for now, but the road ahead may not be as smooth as it once was. Stay subscribed for more videos.